The third quarter ended on March 30th, so the comments in this video pertain to that milestone. In the financial world, results are measured every 3 months. Of course, a single quarter or a single year means little. But examining the latest quarter in the context of longer periods can put things in proper perspective and help an investor stay on a prudent course. The first 3 months of 2016 were a seesaw ride. The first 6 weeks of 2016 actually were widely reported to have been the worst start to a year for U.S. stocks since public company share prices were first recorded in the 1920s. Then, America's blue-chip companies surged in price once again. In the second 6 weeks of the quarter, stocks fully recovered from their dismal start to the year. For sure, the stock market has exhibited higher volatility in recent months. The Standard & Poor's 500 stock index opened the year not too far off from its all-time high in 2015. In January, share prices tumbled. By January, evidence of weakening in the Chinese economy had been mounting for months. This set off widespread fears that a slowdown in the world's second-largest economic engine would drag down growth of the global economy. Meanwhile, oil prices were plunging to lows not seen in over a decade. Investors became so spooked at the prospect of a global slowdown that they focused on the negative effect that lower oil and commodities prices would have on nations whose wealth is tied to exporting commodities. Investors ignored the positive effect lower oil prices would bring to the consumer-driven U.S. economy. The turning point in the quarter came in mid-February, after a string of positive economic news and corporate profits confirmed that the U.S. economic expansion, which began in 2009, was still intact. Emotion and sentiment shifted, and fears of a global economic collapse subsided. The increase in volatility is more evident in this one-year chart. Just look at these ups and downs. On August 24, 2015, there was a one-day flash crash correction. The Dow Jones Industrial Average reportedly declined 1,000 points in the first few minutes of trading, before recovering sharply that day. That drubbing was followed by a steep run-up in October 2015, but that was followed by another double-digit plunge in the first 6 weeks of 2016. After 6 weeks of rebounding ended in the first quarter of 2016, the price of the S&P 500 hovered just below all-time highs as the second quarter got underway. Though past performance is not a reliable indicator of future investment results, the heightened fears seemed likely to continue. While investors were willing to pay only about $12 for a share for the average company in the S&P 500 at the beginning of the bull market in 2009, the steady rise in stock prices over the last 6.5 years means stocks are more highly valued now. Investors recently were paying about 50% more for every dollar of profit earned by the average company in the blue chip index than in 2009, when stock prices bottomed. With stocks more fully valued now, they are more susceptible to emotional drops and ephemeral changes in sentiment. As the second quarter begins, stocks are far from overvalued based on objective measures, as shown in this chart, compiled by Fritz Meyer. Meyer is an independent economist whose research we license to share with you in regular reports just like this. If you are concerned the stock market is overvalued, look at the gap that opened between share price and earnings in the tech bubble of 2000. That was a bubble, and you could see prices losing correlation with earnings. No such gap is evident now. The two red dots in the upper right shows Wall Street analysts' recently estimated bottom-up S&P 500 earnings per share of $121.48 for 2016 and $137.52 for 2017. No one knows for sure that companies in the S&P 500 will meet earnings expectations. Politics, terrorism, bad economic news, and other unexpected events could scuttle companies' plans for meeting their profit objectives. On the other hand, if nothing out of the ordinary happens and companies meet expected earnings forecasts, those two red dots, future earnings, would pull the black line higher. That's because earnings drive stock prices, and economic fundamentals, measured by growth in the economy, drive earnings. On April 1, 2016, the second quarter started with good economic news. The Labor Department's monthly jobs report showed that employers added 215,000 jobs last month, evidence the economy isn't slowing down. The jobs report was stronger than expected. It showed employers are confident enough to add staff, even though overall economic growth has slowed down a bit. More importantly, more people look for work and wages edged higher. Those are two very good signs. In addition, automakers reported U.S. sales gains in March strengthened to its best level in 16 years. According to Kelley Blue Book, U.S. auto sales rose 3.2% to 1.59 million last month, the best March since 2000. The volatility in stock prices of recent months is very visible from this chart, showing 5 years of bullish stock performance, which is punctuated by two stunning dips in August 2015 and January 2016. While the market is trading at a higher valuation and more susceptible to emotional dips, what's most important is that the economy continues to show signs of strength as the second quarter is getting underway.